Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance.
Hello and welcome to another episode of the Wall Street Lab podcast. Our treat for you today is my interview with Toby Main. He's a serial entrepreneur, private equity manager, and a jack of all trades when it comes to private side investments. Toby is the co-founder and managing director of Efficient Frontier Investing, a Swiss-based financial product engineering firm. He also founded Isla Capital Management, a company that provides bespoke financial solutions in asset management and advisory services. And before that, he was active as Interim CIO at Isla Capital and active in several roles at Bedrock Group, one of Europe's biggest family offices. Toby tells us about his approach on getting returns above the efficient frontier by understanding, quantifying, and managing risk. Toby also takes us through his investment process and gives us some great insights into the private equity market in Switzerland. We also talk about the importance of mentoring, having a good reputation, and building trust. What Toby didn't mention in the episode, but he sent me a link afterwards, was a great TED Talk on coaching and mentoring that he wanted you listeners to know about. The talk is named Want to be great at something? Get a coach, by Atul Gawande. If you're interested, the link is of course also in the show notes, and I recommend you to check out the video. It's really insightful and really good. And as usual, if you liked the episode, please leave us a 5-star review on Apple Podcasts or wherever you get your podcast from. And now, without further ado, our interview with Toby Main. Toby, welcome to the Wall Street Lab podcast. I'm so excited to interview you today.
Thank you very much. It's nice to see you again after a few weeks of not really interacting with people face to face. It's nice to have a bit of interaction again. So it's nice to see you too.
Yeah, so maybe for circumstances, we're in the middle of the corona pandemic, end of April. How are you coping with being stuck at home?
It's been a bit of a change. I unfortunately actually got the virus a few weeks ago. So I've been dealing with trying to keep myself away from young family, and my wife has been leading the family on, developing at-home schooling, also doing a degree at the same time. So my hat's off to my wife, I have to say, who's been supporting me incredibly throughout this whole period. So it's a big thank you to her, really.
Props to her, absolutely. Now, Toby, let's dig in. Can you tell me about your background? Who are you and what do you do?
Sure. So who am I? I'm Toby Main. I currently own and run a business which is called Efficient Frontier Investing, based in Switzerland with 2 business partners. I guess maybe if we wind back a little bit and go back into the history of where I came from to end up here, I'm guessing some of your listeners probably want to get an understanding of the education route that certain individuals take to get to where they are. I studied mathematical physics in the UK. At the time, I found out that actually I wasn't really cut out for university life. I enjoyed a lot of the social scene that came with it, but actually my mentality was really built towards doing things rather than doing the research behind things. I left university, moved to London, and couldn't find a job actually to start with. So I started working as an estate agent. And after a few months of doing that, I realized actually my drive was really to look into the financial markets and to try and find a foothold, try and get any way in to get into the market. I was fortunate that I met a few guys who were able to introduce me, and I started working at UBS at the investment bank, working really primarily in the operations side, looking after the smooth running of some of the bank's operational side of things, mainly for the hedge fund clients. So it was in a sector of the bank which was called prime brokerage, which is really the interface between the hedge fund community or the large pension funds or pooled capital, the investment bank, and how they would then, it was the operations that supported their trading and their settlement. I was very fortunate that I then met one of my clients a lot more often, and I really helped them grow their business very much more on a friendship basis than on a business basis. And that developed. and I left the bank and went to work with one of my clients, which was a multifamily office that really had a hedge fund background. So I knew their hedge fund business from working at UBS. And the development from that was that I moved across to help them on some of their junior trading and portfolio management, and learned that actually there was a wider business behind it that supported their hedge fund, which was a wealth management. I moved from the UK to Switzerland in 2008 full time, and I've been based in Switzerland ever since. And around about 4 years ago, after moving up through the ranks, doing the trading, portfolio management, then moving across to run some of the actual client accounts, to then sitting on the investment committee, to then directing a lot of the boards. So I then actually was the interface between all of our hedge funds and the boards. I left the wealth management business to a company called Bedrock, which at the time we had grown from being, I think, 8 or 9 people when I joined to 105. And we were the 25th largest multifamily office in Europe. Bloomberg had done a survey on it, and we kind of appeared, which I think was a bit of a shock to everybody, because in typical Swiss fashion, we didn't really talk to anybody but our own clients. So to suddenly appear in a Bloomberg survey, I think was a bit of a shock to everybody. And it was really ratification to show that the business had grown very successfully. I was very fortunate through my whole time to be supported by some of the early founding partners. And those really became my mentors. And I still remember my first, I actually ended up having 8 interviews to join them. So I would say first interview, but it was closer to the last one. And I met the most senior in terms of, I guess, his age, who is now actually my business partner, having left Bedrock. He left Bedrock as well, sold all his shares and came and joined me. We sat in one of the early interviews, and I was a young guy, left the investment bank, and I was determined I was going to be a trader. And, everybody that was cool was a trader. And he sat me down very calmly and he looked at me and he said, "I'll tell you something now." He said, "You don't want to be a trader." And it was a little bit like one of those Jedi waving of the hand tricks to say, "You don't want to be a trader." He said, "I think that you really want to be a portfolio manager." And he said, "You have a fairly good understanding of what risk is." And he said, "Before I hire you, I have one question." And he said, "I want to try and understand if you understand what risk is." I said, "Okay." He said, "You have a background in physics and statistics. Answer me this." And just for you to understand, his background is he originally taught part of an MBA course to teach risk. So this is where his background kind of comes into it. And he asked me the question, which is riskier, jumping out of the 3rd floor window of the Empire State Building or jumping off the roof, the very top? And fortunately for me, I got it right. But he said, 9 times out of 10, when he asks that question, most people will say the wrong answer. Because people's association with risk is that risk has a negative outcome. Oh, it's risky. And everybody then hears teeth sucking. Of course, the answer is risk is supposed to be measurable. And I've listened to a lot of your previous podcasts, and obviously you had one of the absolute icons of the finance world recently with Howard Marks. I've read his letters ever since I started, really. So, I've read a year's worth of his letters. And he said there are even ex ante, you're not able to measure risk, but there's an understanding of risk that goes into it. You may not be able to answer what all of those risks are, but being able to identify risk in the first place is part of his ability in many ways to make sure that he tries to avoid picking losers. And of course, the answer to the question that was raised is it's more dangerous jumping out of the 3rd floor window than it is jumping off the roof. If you jump out of the 3rd floor window, there are a multitude of potential outcomes for you. So from a risk perspective, that's much riskier. If you jump off the top of the Empire State Building, I guarantee you there is one outcome. And the idea of it being a negative outcome is because most people don't want to die. However, if you're trying to, end your own life, that is going to be an absolute certitude. It's very risky if that's your outcome, your desired outcome, to do that from a 3rd floor window. And I think that was really, really one of the things which I learned from very early on in my career, is that you have to be able to, if you like, stand on the shoulders of giants. So learn where you can from speaking to mentors. And if you are able to get a mentor who's able to support you through your career, stick with them and make sure that you listen to what they say and ask them questions. Because I think that was really what then helped me grow in my role, was I listened. I spent a lot of time listening. I've not been in the finance markets as long as a lot of the great giants, the Warren Buffetts of the world. He has a few more years on me. You ask Howard Marks, who was on recently, who was reading his letters to start with, for the first 10 years, he said no one. But when everybody quotes his performance, they go back to 88 or 89. So it's a career that people are viewing now. If you go back to when he started his career in 88, 89, really kicked off the career, he probably wouldn't have had the same impact that he does now. Well, for certitude, he didn't. And I think that's really what is interesting for people to try and learn now, is that at each part of your career, you have something different that you're trying to learn, but you should always be learning.
I love the story about the interview, and usually I would dig into what you actually do, but now this topic just came up immediately, and I want to dig a bit deeper on mentors, because I've had guests in the past that say one part said, hey, you need a mentor, it's very important for you. Others said, actually, I never had a mentor and I am absolutely fine with it. It actually probably helped me because I could ask 10, 20 people for advice on a single topic instead of having one person to go to. I guess your opinion on mentors is that they are absolutely a positive thing. And then why do you think that?
Mentors can come in different ways and different forms. Listening to one podcast or listening to one interview or reading one book, is going to give you an insight. Having somebody that you can interact with on an ongoing basis to be able to see how you have developed and to see how you have interacted in the past and to try and help guide you. It's not essential, but for me, it is something that is you are able to benefit from somebody else's wisdom. What's also important is to make sure that you have the right mentors. Having just anyone guiding you, clearly that's not the purpose of having a mentor. You don't necessarily have to have a direct interaction with them. So for instance, as I mentioned earlier on, I've read probably every single letter that's been written by Howard Marks. I used to read a letter which was called the Gartman letter, which was a fascinating read for getting trading insight and really having an understanding of how people who have been in the markets react. There are other types of mentors that you can have rather than having an interpersonal relationship with somebody. I think the difference that I found is when I was actually able to speak to somebody and sit down and have a coffee or sit down and have lunch, and you have a conversation which leads into it naturally rather than trying to force your ideas into, I've read this in a book, how do I apply it to myself? Or how do I apply it to my situation? I don't think any one piece of information can help you move forward in your understanding. I think it's the idea of being able to see how you develop and how you understand. My business partner, Sandy Koifman, was that man who had that interview. And at the time, he said to me, you don't want to be a trader, you want to be a portfolio manager. At the time, I didn't know what the difference was. That's the reality. It was a title on a page. But having that knowledge and that insight to understand the background and to see where you fit, and the knowledge of having run trading desks globally for Safra and alongside some of his sort of kind of fellow finance titans at the time in the 80s and the 90s. It's that knowledge which allows people to provide some kind of guidance to you. And you don't necessarily have to follow it, but I think that if people are providing guidance to you and it's based on the historic involvement in a sector that they understand, then taking that knowledge on board and at least having it as an opinion for you to be able to listen to is invaluable.
And how do you go about choosing your mentors? How do you find the right mentor?
That's a really tricky question. And without wanting to sound like I'm quoting something from sort of a Harry Potter film or something, I think the mentors almost choose you. It's one of those situations where you normally will have a personal interaction with them either on a business or a personal basis. You have an affinity to be able to speak openly with them. If you're not able to speak openly and talk about sort of most subjects, it's very difficult for a mentor to actually be able to help and guide you. I think it's more a process of being able to speak to people and make sure that you keep those connections open, and then you can develop those relationships. It's not a one-stop. Tomorrow, Andy, I want you to be my mentor. I don't know enough about the fintech space. Please, I would like to learn from you. I mean, you and I have very good open conversations, and we chat about various things which develop and actually lead into other conversations. And I think that is a way of learning and actually having a mentor specifically. I'm just very fortunate that I worked with Sandy very closely for 11 years, 3 years as a client, 11 years working with him. And then I left, went off to do my own things, and we came back together again. A mentor doesn't have to be stood next to you every single day of your career or of your life.
That makes sense. And I think it really fits into what other guests told us about. You don't necessarily have just like one mentor figure, but you can choose from 1 to X amount of people. Now, I want to switch gears a little bit and talk about risk. You mentioned risk before and how you might think different about risk than most people do. And while looking in
Efficient Frontier Investing, which is your company, you also have a lot of emphasis on risk. How do you try to understand and manage risk while doing what you do?
Great question. We have a belief that the returns that you will get from an investment are defined by the market, and therefore you can't manage returns. What do I mean by that? If you and I enter into exactly the same trade, but take the either side of it. So I believe, as an example, that Amazon shares are going to be going up by 100% in the next 3 weeks. Okay, let's just make a large example. Okay, if your belief is that the Amazon is actually going to halve in price over the next 3 years, we have a different expectation for the return, but the risks that we're probably viewing in it will be similar. Okay, so we will be viewing the same actual asset itself with a different expected outcome. If we close our trade on exactly the same time, if we basically swap our positions, so basically I buy on day 1, you sell on day 1, and then on day 10, I sell my position and you buy, we will both have the inverse performance to each other, and the risks we took in principle were exactly the same. Our performance, however, will not be what we said day 1. I can guarantee you that. When you then have the same expectation, so if we're investing into 2 products, we're investing into Google and into Amazon, and we have an expectation that over the next year, they will both go up 20%. In principle, the risks that we are taking with a business are similar. We are taking technology, we're taking management risk, we're taking compliance risk, we're taking operational risk, we're taking payment risk within some of those. We're taking in a list of risks that are as long as your arm. If you have the same expected return for each of those investments, but you can find a differentiating factor in the way that you look at the risks to say, actually, there is significantly more risk within one of those investments that you can quantify and that you're able to minimize without affecting the returns, we would prefer to take the one which has a lower risk, in our opinion, of visible risks to allow us to achieve the same expected return. Everybody who's probably listening to this has either looked into has looked at, let's say, Finance 101. You have what's called the efficient frontier. It's if you take a scatter graph of performance of the portfolio versus the risk measured normally in volatility or a derivative thereof, and you map them into a scatter graph, the line of best fit gives you your efficient frontier. If you picked an investment that sits above that investment frontier, you effectively have picked an asset which has performed better than the median of the results, which means that you have received a better return for a lower risk versus its peers. If you're below that, you have had a lower return for a higher risk. Our view is that although we can't know beforehand what the actual outcome will be, we are able to analyze some of the underlying risks and are able to quantify them. If you're able to quantify those risks and you have an asset or an expected investment that has the same expected returns, but one you're able to quantify and find a way of reducing those risks, we would prefer to take the asset which has the same expected return with a lower risk. Now, that might seem simple to say, but actually the difficult part is in identifying those risks. And going back to the earlier conversation, that's a case of time, experience, and having made mistakes. You don't learn by actually doing it right the whole time. Otherwise, your mentality becomes, well, I'm a genius. Anything I touch turns to gold. You will learn how to manage risk when everything goes wrong. What is it that I missed originally, which should have identified why we led to this risk? And a good example I won't name it because there's still a current investigation going on to it in the SEC, and I don't want to create problems. But there was an investment fund that we looked at 2017 to invest into. And the performance of it was very steady. They had a few down months here and there, but the graph basically went from bottom left to top right in a relatively stable, straight-ish line. And for me, if you read everything in the prospectus, you could explain exactly why it had that profile. But there were certain parts in the offering memorandum where basically the CEO had the right to allocate positions to any portfolio that he chose, and he had the final say, and he also had the right to access any of the client accounts. Now, this is something which we then said, look, we can't take those risks, even though the returns are wonderful. It's the knowledge of actually how a fund functions to know that is not normal. And that single point, you can have key man risk, but actually when that key man risk is how to deliver performance, not on the axis that they have. There's a very, very famous case, which was obviously at UBS in just after the Lehman crisis, where actually it was directly after the central bank intervention in Switzerland, where UBS unfortunately had to take a significant several $billion write-down. And again, that was operational. That was operational risks, which you may not be able to quantify unless you actually understand how the systems work. Normally, you have a reliance, but an inter-team dependency. So one team can't check their own work. And what happened in that situation was you had one person who had access to the back office, middle office, and front office system, and were able to manipulate the trades to hide what was actually going on. And again, unless you've been in one of those situations and understand the actual flow of the information, it's very difficult to sometimes quantify that. And these are the unknown risks which you can't identify unless you have the experience. Some of them you won't ever identify, but unless you've actually had the time on the ground, actually doing the work. And that's why I think the experience of spending time within different parts of the finance industry is essential.
Can you define for listeners what is key man risk in a fund?
Key man risk. Key man risk is the identification of the outperformance of a fund if it is driven by one person's knowledge. And if that person was to disappear, the fund would no longer have its ability to deliver the performance. That person is identified as a key risk, key man risk. I.e., if you were to take that person out of the situation, you no longer have the same performance capabilities of the fund. Therefore, as an investor, you have to understand that your risk is identified directly with that person.
Okay, that makes absolute sense. Now, can you tell us a bit more about what kind of experiences, what kind of mistakes, I would be very interested, led you to find those ways to reduce risk? Because as you said, for me, it sounds very obvious, right? Try to find a investment with a 10% expected return and then try to find the one that has the least risk. Well, I'm like, okay, yeah, sure. Isn't everybody doing that, right? But what mistakes did you maybe make in the past that led you to now see those things like the fund you described, right? What kind of mistakes or experiences did you have before that were like, wait, something is off here?
That's a great question. Maybe if I can go broader than that, rather than going down to individual mistakes, maybe looking at a broader, which on an asset allocation basis. Most wealth managers or most investment managers will take a top-down approach to start with to define the asset allocation that they want to go into. Asset allocation meaning where is it that they want to allocate their capital? That can either be to protect from a protection standpoint or from an outperformance generation, or simply to fulfill a specific investment management mandate. From a personal perspective, one of the things which I learned fairly early on is if you deliver your asset allocation into too broad a spectrum of investments, first of all, you become like any index. So don't expect to have an outperformance if you hold 0.5% of every single asset. That simply won't deliver you an outperformance. You become the same as an index, and that's the first part. The second part is, if you really want to know what's going on in your portfolio, you have to be able to follow it. It is not possible for any portfolio manager globally to have more than maybe 50 positions that they're managing. People can have a risk view overall. If you're looking at a portfolio of assets, you simply don't have the time in the day to be able to allocate enough time to actually monitor and understand what's going on. I think that's really one of the first points. So for me, I like to know exactly what I'm investing into, and I like to get dirt under my fingernails. There's nothing better than sort of really getting involved, speaking with the management and understanding what's going on. Will you be able to identify issues? Sometimes yes, sometimes no. But a lot of that then also comes into the experience of actually having met a lot of people, being exposed to those that can deliver, those that have delivered, and that those who are simply trying to broker a transaction and actually have no value to add and can't actually add any value beyond the fact that they know two parties. Now, that is a very important part to the marketplace. But you also then in that position have to know what the limitations of your counterparty. So I guess going into specifics, probably one of the biggest costs, I would say, that I have had to bear over the last 10 years is probably with lawyers. And finding a lawyer that you can, one, trust is not difficult. Most lawyers can be trusted to be able to deliver the law. The second part is being able to find one that can actually implement what it is that you want from a commercial aspect to a negotiation in a contract. If as an individual you are leaving the lawyers up to negotiating contracts, first of all, your legal bills will go through the roof. And secondly, you end up with a very, very long legalese document that won't necessarily actually solve the financial problem that you are trying to solve. I have definitely learned that the hard way. And once you've signed a contract, you are bound by the terms of that contract. And it can be incredibly frustrating, even for both commercial parties, if they're bound by the terms of a legal document, which actually doesn't necessarily service the needs of the actual business that they're carrying on. So I would say that's one of the big lessons that I've really come across recently.
Can you give an example of what financial problem you would solve with such kind of contract?
Sure. The simplest being a sale and purchase agreement. You're entering into an agreement with another party who either owns the asset or is looking to buy an asset from you, whatever that asset is, whether it's shares, whether it's a bond, whether it is a private placement, whether it's a property. The document that governs any transaction in this particular case is a share purchase agreement or sale and purchase agreement. Some people call it an SPA, some people call it a PSA, purchase and sales agreement. And the terms that you write into some of those contracts are what the parties are bound by. And some of the recent transactions we've done are into private equity. So we are going into a company, we've bought a company where the underlying business, you have the statements of the management, you have the audited returns, and you then have to trust that what you're buying is exactly what's on paper. But if you don't state on paper what it is that you're buying and your understandings, you have no argument after the fact if there is some urgent matter which should have been disclosed beforehand and it hasn't been disclosed. It often leads to either litigation or it leads to acrimony between the management parties if they're continuing to work in the business for not having disclosed it in the first place. So it's some of the specific terms. We very recently we ended up going into a company where there were non-disclosed debt positions on the balance sheet, which came out shortly afterwards. And unfortunately, with the documentation, it wasn't actually governed how that would be dealt with. And due to the warranties that were given, there was no other way to deal with it. But we ended up having to take on that debt. Now, luckily, it didn't change the metrics of the business plan for us. However, it's an unforeseen cash flow item that you will then have to deal with, which changes the planning, which changes your cash flow, which then changes the way that you look at the business. And it can be very frustrating.
What I would like to know more is, can you tell us what else you look into? You say you talk to the management, you try to get your fingers dirty. What else do you do before you invest into a company or do any other kind of transaction?
One of the early decisions that you have to make from a risk perspective is, do you actually like the business itself? Regardless of whether you're looking to invest for continue to own the business or whether there is an outcome. Sometimes we'll be buying distressed businesses because we see a value in being able to turn the business around and then sell it on. But just because there is an opportunity there, you actually have to like the underlying business space. And a lot of the time, the risk that you have to understand is by speaking to others who are in that space, who are more knowledgeable than you. Finding those counterparties to be able to rely on takes time, and it is difficult to do. You have to have counterparties that you can trust and that you can rely on in difficult situations. The idea of reputation and being able to rely on a reputation is an old concept. It goes right the way back. You've seen in a lot of films, everybody saying, my word is my bond. Well, that is how business, I say, it used to be done. I would say a lot of the time it still is done on a handshake and an understanding, as long as the reputation is there to be able to support it. Being able to enter into transactions with counterparties that trust, and you understand will be able to deliver when it comes to actual performance. That's very important. Reputation is something which can't be undervalued. We did another lending scenario recently where 20% of the allocation of the risk that they gave to it was based on the reputation of the management. Were the management skillful enough to be able to manage it? Do they interact well with the marketplace? Do they have a good reputation with other counterparties? Do they pay their bills on time? These might seem like basics, but actually it counts an awful lot to understand what somebody's history is. History may not repeat itself, but it certainly rhymes. I've heard that a lot. I've said it a lot, and I truly believe that that's the case. The moment that everybody says this time it's different, I think I read a report that was issued at the end of 2019, which said that it was the end of the boom and bust cycles, and these cycles no longer existed. We were in a new super universe that would allow the markets to be able to go away from these boom and bust cycles. I think that everybody can be pretty sure that post-COVID, it may not have been a bust, but it's certainly heading towards recession. That's something which is very difficult. You see the commentary coming out that a lot of the numbers which are being touted now, that this financial recession should be worse than 2008. It's a very different type of recession this time round. But by the same token, you can't deny that the fact that this has rhymed in many ways. It may not have repeated exactly. 2008, 2009, all the way through to 2020 is longer than the 10-year cycle that everybody is expecting, but it's not much longer. We had 2017 in between with a little blip. It's very difficult to understand the risks assuming things will repeat. They won't necessarily repeat, but you can form a view on people's reaction to scenario. And I think that is what's important to be able to understand when you're analyzing the risk from reputation.
Just before the financial crisis, exactly the same papers came out, Oh, now our industry is so stable, everything is perfect, there's no way we ever gonna have a bust again, and bam, there it was. So maybe we should set up a trading strategy. Whenever somebody says there's never gonna be a bust again, go short on the market.
I think it's a fantastic idea. I mean, there are some much cleverer people out there than I. There's a fantastic quant manager by the name of GSquared. I guess they're one of the last few groups that are actually independent. A lot of the big quant managers got bought up by the Millenniums of the world and these large multi-strat managers. And it's run by two geniuses is the only description I can give from that. And they're extremely humble in the way that they view portfolios. You're talking about risk management and being able to set up these triggers for managing. When everybody says there's no bust, you should probably look to sell. Well, I mean, that's more or less the way that they have built their portfolio. I think that my idea of being able to massively undersell it is not sufficient. But their management style is somewhat contrarian. They take the view that human perception of the way that the markets trade and the behavioral finance that goes with that means that humans are actually not very good at portfolio management. If you look at their funds return, I probably would tend to agree with them. But I think that's on a wider management scale. So they actually have set up and they have these monitoring tools. The system will tell them when those monitoring tools have enough flags for them to say it's unloved, but actually all of the fundamentals now support that business to move forward. They then have the human overview on it to basically say, yeah, but they've just gone into chapter 11. We can't invest into it. They will then have the human overlay of saying, yes, this is actually sensible in the real world. So rather than them having the black box scenario of, oh, wait a second, our black box is just selling everything and we're out of the market by 40-50%. That's not the way that they manage it. They have a human overview, but they have what they call 36 digital analysts, and they do exactly what you've just mentioned. They take a completely black and white view. They analyze data in a very, very strict manner. And when those flags come up, they're then brought forward as investment opportunities. I think you're right. If there is a way to actually not automate, but to be able to provide some colorless view on the market is probably a very sensible way.
There are some theories that actually when people talk to one another, the result is distorted by the personal feeling that you have in the conversation. So somebody might be very skillful in pretending to build a friendship and is actually distorting the real view on reality of the company.
I don't know whether you've heard of this. It's a physics principle, the uncertainty principle. And it basically says that you can't define the velocity and position of a particle precisely at exactly the same moment in time. And I think that applies to human nature. You may well be able to get a very, very accurate read on one part of the business, but normally what that means is that there's another part that you don't understand as well. What you really need to be able to do is to be able to have a group of individuals who are able to attack them. A good example is the way we do our venture capital in Switzerland. The screening that we actually do, we have a partner who does all of that screening, which is a not-for-profit group in Switzerland. Everything is automated. For the initial part, for anybody to apply to be able to get into the foundation to get support, and hence the investments that we would then be able to support them with, they have to go through a strict screening process. So last year there were nearly 500 applications through the automated site. That ended up coming down to around about I think it was 150 interviews, of which it was based purely on the mathematics of the business plans and the development of the business as it stood. Purely factual. This is over the telephone, not face to face. After that, when they understand what's going on with the business, there is an actual human component. And funnily enough, the most successful CEOs that we have within that group are not necessarily the most personable. Actually, they're the guy that will turn around and go, Andy, I don't really care what you say. I'm doing this because I know it's right for my marketplace. Now, that's a fine line because you have to be able to judge that person can make the right decisions to grow the business globally, rather than just being able to make micro decisions and micromanage the company. So again, it comes back to that comment. Most of the advisors that we have been doing that for 25 plus years. The main advisor we have, sure, he probably won't be too upset with my description. He's seen as the grandfather of venture capital investing in Switzerland. He's developed a lot of the angel groups, and that knowledge comes with things like, well, I understand what you're doing with this project here, and someone can come up with a crazy idea. 4 years ago, we had another group that developed it like this, and these were the problems that they faced. Can you tell me how you would face those problems? A lot of entrepreneurs won't necessarily look beyond this single problem that they're trying to solve. And that is really where you need to have somebody that can lift their head up and say, okay, not only will we be able to approach those problems, I actually see beyond those problems to be leading to product number 2, 3, 4, 5, or service X, Y, and Z that then leads on from the business. And it's having that vision that they can deliver on. And, out of those 500 companies, we only take maybe 10 to 15.
How else do you decide what companies you take on? What other maybe questions or tests do you do to decide which is the best company out of those 500?
The sorting process obviously leaves us with, there are certain factors which have to be fulfilled, and there have to be unique points which actually differentiate the product. So that cuts out 350 of them in day one. Going through the telephone process allows you get down to someone who actually understands the business and how they can grow it. And then the last part, which actually allows them to move into the foundation, is that they have to pass a specific, almost like a point system. And we have a specific risk ratio that we generate, and it is per idea and per company, which allows us to make an informed decision as to there is a better than even chance that this business will be able to deliver something based on the understanding we have of it. That's where we make those decisions. Now, you look at the likes of some of the large venture capital firms who've been running their last portfolios. Sequoia is an example, and I think their last fund had had a failure rate of about 91% on its companies. So I think our process, where we have a survival rate after 5 years of nearly 80%, the idea of being able to introduce an AI function to understand how to quantify risk in the first place, or understand how to quantify the idea, allows us to develop more sustainable companies. And I think also our view to start with is we're not necessarily going in with the same mindset of being able to flip a company within the first 3 to 5 years. So the standard process for us is we will look to take 1 or 2 capital investments into a company, grow it, and then have a trade sale or some form of M&A activity. We're not necessarily looking to go to a listing. In fact, in Switzerland, most of it is a B2B business anyway. So they're highly cash producing businesses if they're successful.
Before I ask you to tell me a bit more about risk ratio, can you quickly define what is a trade sale or an M&A activity?
Sure. So most of the companies that we look at in Switzerland are B2B, meaning that they are delivering a service or a product from one business to another. They're an integral part of it. So if you have a product chain or a process chain that's actually being put together, you are finding a way that there would be some interaction between the two counterparties, and potentially what you would have is a buyout by the receiving entity would potentially look to buy out the producer so that they get a vertically integrated business. So a great example is, do you have an iPhone?
Yes, I do.
Okay. So you know the new face recognition. That software was actually generated by part of it, I should say, not the software, apologies. Part of the actual technology behind that was 3 companies that were bought out by Apple between 5 and 7 years ago. And there were 3 companies that were based within Switzerland, actually around the Lake Geneva area. And they were bought out years ago by Apple, and now it's seen as their product. That's what I mean by a trade sale. You have someone who's creating a product or a service that's useful to another business, and the business itself will then choose to buy that product out, to internalize it, rather than to pay for a product or service externally.
Now, can you tell us a bit more about this risk ratio that you try to calculate? And maybe an additional question, why is it so different from Sequoia's approach?
Let's look at the Sequoia approach versus us, and then I'll go into the risk. So I'm not necessarily singling out Sequoia because that's not fair. But if we look at a general approach to venture capital or to early stage investing, there historically has been a trend for what's called spray and pray. That means you would generate a large fund, you would go out and you would buy basically tickets. Just for mathematics purposes, I'm making it simple. You would go out and buy small stakes into 100 companies. You put in $100,000 into each of the companies. Now you have a portfolio of companies that you can look at, and the ones that you like, you can try to add. You add to those positions, and as the rounds go up, hopefully they're all up rounds. Eventually you add to your positions and you end up with 2 or 3 large companies, which hopefully are unicorns, and you deliver a significant outperformance versus the rest of the market, which maybe only hit 1 or no significant performance. We take a different view on it. One, Switzerland is a bit of a different country to everybody else, as you're probably aware. One of the questions we get is why do we even bother looking at Switzerland from a technology standpoint or from an innovation standpoint? And for the last 8 years, Switzerland has been the number one globally for innovation. And Israel has done a wonderful job of defining itself as the innovation nation. Silicon Valley, Silicon Valley. You don't need to say anything more about that. But Switzerland actually has been developing very boring, very stable technology for companies that are able to actually deliver a strong business and therefore a strong cash flow over the long term. Most of those, if we look at who is here in terms of the big listed company, medtech is something that's very strong in Switzerland. That might seem strange, but actually when you look at it, what are some of the largest listed companies that you have in Switzerland? You have Novartis, you have large pharma companies here. If I'm a pharma company and I have a large amount of profits which are being pushed back to a holding company, what's the easiest way of reducing your tax burden is to book a big cost center there. Well, R&D is a great cost center, so it can obviously become a profit center as well. But the argument being that when you're doing research and development, that is effectively a big cost that you have to invest to be able to drive your business forward. Those big budgets are obviously based here. Switzerland has a unique university system where you have huge amounts of foundation support, which deliver into the local market non-dilutive capital. What do I mean by non-dilutive capital? I mean, if you're an individual who is doing research into cochlear implant, basically to be able to replicate hearing in someone who is deaf or who is partially hearing, you have to have money to be able to investigate it. Most research analysts won't have that. But if you have a new idea and you're able to pitch it to a foundation or to an external R&D lab, they will provide the capital for you to be able to do that research. It doesn't go into anyone's pocket. It is given as a non-dilutive. It doesn't change the capital stack of a company. That money is effectively free money into the company. Most individuals who apply to whether it's ETH or whether it's EPFL or whether it's Fongit, which are some of the big foundations or innovation hubs, the vast majority of those individuals who are developing product or developing services actually will have a huge amount of capital that's already been injected, whether it's through the university, research grants, through foundations. They already have a huge knowledge, potentially IP, and they've already got 4 or 5 years worth of development behind them by the time they actually come to bring it to market. So by the time you try to generate a company, you already have the equivalent of 8 million of invested capital, 5 million invested capital, a large number of invested capital, which goes into the idea. By the time it comes to a foundation and we're able to look at it and we invest alongside that foundation, which is supported by the state of Geneva, you actually end up in a situation where you have something that is a real business or a going concern before you have to put a penny into it. And a lot of the times, the company which is still being founded is still at the same valuations that the guys in Silicon Valley or Israel will be going in at on day one. The difference is you really have a company that looks like a Series A or a Series A2 round when it's coming in at seed stage. So from a valuation perspective, you end up with a very different company type. And as they're producing B2B, they will often have a cornerstone client that they can go into to generate cash flow early. So there are several. There's another company that we work with at the foundation that we're also invested into, where they have a cornerstone large oil major, I will say, as one of their cornerstone clients. And that client is also then interested in being able to invest into the company, and potentially you can see in the future, if it's something that develops positively for them, they would obviously like to be able to have the opportunity to integrate. That's a natural way that business is done. And that's really what we look to focus on. If there's a way to integrate those businesses, either from an M&A, even internally within the foundation, sometimes there are two companies which would do better together. And if you have that knowledge and oversight of being able to see those companies, how they work, how the management interacts, does the management have lunch with all of their staff on a daily basis? Do they interact with other companies well? Is there a service or product that they're missing, which if they bolted it together, it would make a bigger and better company? All of these things which come with time. And that's often something which is not necessarily granted within a venture capital fund. You have a runway, your money lasts you X amount of time. You either do another raise, which can be an up round or a down round, or you die. And here the state takes a very different view, that they will actually support those companies to be able to help them develop their actual product. And sometimes it takes 2, sometimes it takes 3, 4 iterations of the same product or service to actually deliver a profitable company. And I think it's that mentality of being able to stand alongside companies that we have a long-term belief in that sets us apart.
That makes absolute sense. It sounds like a very, very good model to be in, and a very sustainable one in that. Now, I don't want to take up too much of your time. Do you have any last requests to our audience? Any last tips? Maybe any books? Anything that really can help dig deeper?
I guess there are really two things to maybe think about. One of which is that nothing comes easily, right? If you work hard and you're showing the way that you want to deliver results by working hard, people do respect that, and you will end up getting support. And the other one is, obviously, there are a lot of quotes that people hear. When there's blood in the streets, you should, that's the time to be buying. Well, if you take the first and the last part of Rudyard Kipling's poem, If, then I think it really gives you a good understanding. Do you know the poem or not?
I don't know the poem, no.
It goes something like, if you can keep your head when all around you are losing theirs and blaming it on you, if you can trust yourself when all men doubt you, but make allowance for their doubting too, and then skipping right to the end, if you can fill the unforgiving minute with 60 seconds worth of distance run, yours is the earth and everything that's in it. And which is more, you'll be a man, my son. And I think that lays the right tone. If you work hard, if every time that there's a minute that you can be doing something, you're running and you're making sure you do as much as you can, but just keep your head, keep balanced, the world will be yours. And it might be financial, it might be family, it might be whatever it is that you're looking to get out of life. But as long as you're fulfilling every minute and working hard at it, you will be happy.
I think that's a perfect note to end this conversation. Toby, thank you so much for your time. This has been very insightful, and I hope you stay healthy and stay safe.
You too, and I hope that everybody at home is also, safe and healthy as well.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com. To see what we're up to before anyone else, subscribe to our newsletter on our website and follow us on Facebook and Twitter.
Disclaimer. Information contained in this podcast constitutes the opinions of individuals and should not be treated as investment, tax, financial, or legal advice. We take no responsibility for the accuracy of any statements made in this podcast. This podcast is for informational and educational purposes only, and it does not contain an offer to sell or buy any sort of financial products, and should not be treated as advertisement for such. Any copying, distribution, or reproduction of this podcast without the prior permission of the creators of the podcast is strictly prohibited.